Hey guys, this is George David with George David Investing. In today's video, we're going to be talking about Peloton stock and why I'm personally running for the hills. We've seen pretty much the death blow with Peloton stock, so we're going to talk about just how much bleeding there is. As always, we're also going to be talking about today's stock market news to see about what kind of things are happening in the next 6, 12, 24 months that might be coming up and causing a stock market crash, and how that affects your other positions, portfolio composition, and other good investments that are out there instead of a Peloton. But we'll break it all down, we'll wrap it all up. So let's get into it right now. All right, so in this video, we're going to be talking about number one, Peloton stock analysis, and personally, why I'm very bearish on the stock, why I'm selling. But also on top of that, we're also going to be talking about today's stock market news and how there's developments in the market that are going to be percolating into the market, affecting not only Peloton, but some of the other very strong investment opportunities as well in the next 6, 12, 24 months. Number three, we're also going to be talking about, is it time to buy, sell, or wait with Peloton? And we're also going to break down some of the positives in the short term if you want to make a quick buck with Peloton, and some of the long-term ramifications of the company as well. Finally, we're going to round it out, as always, and talk about triggers for a stock market crash. So let's dive right in. So Peloton currently is doing a run rate of approximately $2 billion a year in revenue. Now, remember, Peloton exploded on the scene with COVID. Basically, it was a COVID stock hail hero that came out and provided those home cardiovascular gym solutions. So a lot of that revenue really exploded upwards to unsustainable levels due to the pandemic lockdown and some of that wait listing for the product that came in about 6, 8 months down the road from the initial lockdowns. Now, Peloton has a maximum revenue potential of $5 billion a year. When you think of Peloton, there's not too many different product segments that they have to offer. The market is nearing saturation. Yes, there was a lot of wait lists, but a lot of those orders have started to become satisfied. So there is some potential for the company to grow, but at the same time, there's only so much of a market that it can hit. Now, don't forget, the big news coming out of Peloton today is that they had to recall every single one of their bikes. So this is a really big impact to Peloton. This is definitely going to impact sales, and it's definitely going to clobber the stock. Right now, we're currently down 13% with Peloton. But again, there's some things to consider. I'm going to break that down in just a moment. So with that in mind, Peloton has a 150% growth rate potential. Now, this also takes into account the potential goodwill damage that Peloton is experiencing with being clobbered by exactly what's happening with its recalls of all its products. 70 people injured, 1 person killed. That's pretty bad. That's pretty bad PR right there. So this does still take into account. That number actually would have been more towards $6-7 billion over the next 10 years. So when I make that projection, I'm taking a look at maximum revenue potential within and about the next 10, 15 years of the company. So $5 billion a year. We're talking also about potential international expansion. That number did get shifted downwards because of that goodwill impact that's going to happen in the short 1 to 2 year time frame with Peloton. And that means that the company has only an okay company growth potential. And we're going to dive more into some of the other factors as well when you're taking a look at Peloton stock, whether it's the right investment opportunity for you. I can tell it's definitely not for me. And that's partly due to the fact that the company only has a growth potential of about 150% right now. And even if it didn't have that traditional way where it would have been about $7 billion a year in revenue down the road, that being a reflection of how much growth is still out there, then we're still looking at a multiplier of about 200, 250%. And there's other investment opportunities for you that's going to produce that upside without limiting the downside we'll touch upon shortly. Again, Peloton also is not a mass use stock. This means that there is some risk about, it hitting a certain point and dropping off a cliff. We think back to BlackBerry in the middle of 2000s. It was not a mass use stock. Peloton is not a mass use stock. There's a lot of people that use it, but no, it's not like an Amazon. It's not like another company that this is something that you would either buy for sure or you interact with on a daily basis. So there's a little bit more risk with those kind of stocks, but at the same time, that's not a detriment. There's a lot of good companies out there with large growth potentials that are not mass use stocks, but they do have that growth potential as well. As always, before I dive into the next really important analysis about Peloton in terms of short and long-term investing, if you haven't done so already, go ahead and smash that like button for me. It helps bring that video out to other people that are looking for this important investment advice. Just put my perspective out there. It also helps grow the channel as well, so it's much appreciated. And if you haven't done so already, go ahead and hit that subscribe button to not miss another video of mine. I try to post it on a daily basis, bring a lot of value completely for free. Okay, moving ahead. Let's talk about today's stock market news. And as always, we basically have the same kind of things that go on into the stock market. The big news stories are, number one, capital gains tax rates. Number two, corporate tax rate increases. And number three, Russia sanctions that, although they're not in the media right now, I view them as very important because it relates back to some of those, not only stock market crashes that might be coming up, but also those awesome buy-in opportunities as well. So number one, capital gains tax rates. This is going to happen in some states. The proposed plan is some of those wealthy individuals are going to be paying well over 50% in their capital gains tax rates. Right now, the highest capital gains tax rates coming out of California. So you have your 20% plus the state level as well. This is a dramatic increase. In absolute terms, this is going from, let's say, about a 30% maximum capital gains tax rates, especially on the rich that makes most of their income from investments that have or are subjugated to capital gains rates, to over 50%. So that's a big game changer. We're going to talk about how that will impact the markets in just a moment. Corporate tax rates increases, as always, 28% is the desired goal. The consensus shows about 25%. And currently, we're at a corporate tax rate of 21%. Finally, Russia sanctions and Russia retaliation as well. Now let's move ahead. With Peloton, is it time to buy, sell, or wait? If you're holding Peloton, get out of there. This is not the right time to get Peloton. Sell. It is not a good opportunity. It's been absolutely clobbered with PR. Now here's the dichotomy here a little bit. It's been hit so hard, yet there's still positive growth momentum that we'll see a nice contrarian bounce with just how much it's been clobbered, not only right now, 13% down today on May 5th, but also it's really taken a clobbering since the top of the market in around November, December 2020 when it exploded on the scene with unsustainable revenue increases because of COVID demand and COVID waitlisting for the product, okay? So now we're about down 40, 50% from highs. Yeah, there's a potential to jump in here, make a quick 5 to 10% in the next couple of weeks, taking advantage of that contrarian bounce. But it is not the time to have Peloton stock. If you're holding out, you got to get out of the position. There's much better opportunity and opportunity cost of your money in places that have significantly more upside and less downside as well than a Peloton. Now, moving ahead, this is really important. I want to make sure we cover all of this. You always, number one, you want to buy at the golden cross point. I always emphasize this in all of my videos, but you don't want to buy a random dip. Peloton, no exception there. We are going towards the top of this tech rally, and you want to always make sure you buy at the golden cross point when the short-term moving average moves above the long-term moving average in a technical dip. And we're going to talk about just that, just those triggers that are going to be coming into the market over the next 6, 12, 24 months that you need to make sure you hunker down with your portfolio. So as always, let's talk about triggers for a stock market crash. Number one, spiking oil prices. As always, I talk about how I have a proprietary algorithm that's analyzed the market for many, many decades. And anytime oil prices spike over 50% of the average of the last 2 years, that very tangibly impacts spending, because now oil prices are rising, which are inputs and people's, not only are consumers spending on it, but businesses as well in terms of transportation and the manufacturing of products and goods. So once that happens, consumers spend less, and also producers can't pass that in as cost push inflation back to the consumer in a reasonable level. Essentially, it creates a spending shock that starts trickling into all areas of the economy. That's why it's really important, we talk about in the next slide after this, why the Russia sanctions are something, although they're not talking about, pose some very real ramifications as well as a catalyst towards a stock market crash. Next, obviously, spiking unemployment rates. Once we go over that 0.6% base threshold from the economic cycle lows, this would be the equivalent of us going from today's level of 6% unemployment to 6.6% unemployment. That trickles into other parts of the economy. That creates a chain reaction of lack of spend, lack of employment because of lack of spend, jobs are losing. That sets the sequence of events of a recession. And then finally, spiking interest rates. At the moment, we do not have those kind of concerns. We don't necessarily have this kind of inflationary concerns that a lot of people are worrying about. We will have inflation, most likely not to the point where we're going to have spiking interest rates like in the mid 70s and early 80s that triggered a interest rate, a monetary recession. And finally, pandemic lockdowns. If we have another lockdown because of a hybrid variant of COVID that's horrible, or another pandemic comes out, obviously that creates a spending issue. That's going to trigger a recession, a stock market crash, up until the point that new money, new credit floods into the market. So finally, let's talk about all of these potential ramifications of things that impact the stock market in terms of when that next opportunity to make a bunch of money in those right investment areas are. So with capital gains tax rates, especially going up over 50% in many states, is this something that's going to create a stock market crash? Is this something that's going to trigger a recession? My analysis for that is actually no. The increased taxes on the rich will be offset. Now, don't forget, the people that are going to be subjugated to these kind of increased tax rates are a very small majority of people, although they do make up a lot of people. A lot of their money, number one, is sheltered in IRA, so we're only talking about 25% of income that is made in capital gains. Of those very small rich class are going to be subjugated to those capital gains tax rates increases. But also, on top of that, the increased tax rates on the rich will be offset by more disposable income in the middle class, because those tax rates are going to be funding more affordable programs and tax cuts for the middle class. So essentially, it's like a Libra scale there, where the rich are paying a little bit more so that the middle class can spend more money, and also have some more programs that lower the amount of money they have to spend, such as childcare, etc. The bigger one, obviously, is Russia sanctions. I talk about that really, really importantly. But although we don't do a lot of business with Russia, and we got to really watch this on a day-by-day level really closely, time to top of the market there. But if Russia starts cutting back supply because they are not happy with the Western world and they have spiking oil prices, then those countries we do, especially these large companies such as Apple, AMD, Microsoft, Facebook, that do a lot of international sales as well, they will be hit by the lack of spending that's coming out of Europe, because Europe is very dependent upon Russia oil. So if Russia spikes up those oil prices and cutting supply, then that's going to affect the tangible earnings of some of those big tech sectors. Any kind of company that does a lot of business internationally, that will actually cause a recession to form out of that. So a recession is possible if Russia radically cuts down oil prices. Now, the final piece of news that we have is corporate tax rate increases. As I said in the previous video, this will only cause a correction in the market. It will not cause a crash. This will cause a dip that will be the perfect timing to go into that next opportunity. I do not believe Peloton is that opportunity. Not only is it being clobbered in the short term, but there's other companies as well with much larger growth potential. So you don't want to be greedy. You don't want to buy in at the top of this tech bubble, even though there might be 6 to 12 months where there's some fluctuations. You want to make your money by getting in at the right time. That maximizes your returns, and you'll make great returns going after those right growth investments while minimizing your downside risk as well. So finally, let's round it all out. A corporate tax rate increase will cause a correction in the market because of lower earnings, because the tax base is getting higher, but the market will rebound because it will finally price that information in, and it won't impact GDP because ultimately that's an accounting issue. That doesn't change the fact that corporations can spend on R&D and other places and hire people. So that just impacts earning. The market will price that in. Russia sanctions, this is not something the market could price in. If there's an oil shock, that's a spending shock. And that's one of the most common triggers of stock market crashes and corrections when you look holistically at the market sphere. And then finally, capital gains tax rates. Yeah, the market's going to price that in. They're going to get a little bit spooked out of that. And there will be a nice little dip from that. And that, in combination with the corporate tax rate increases, if that's in one giant plan, that will cause some issues. But ultimately, everything will turn out good. All right, guys, that wraps up the video on Peloton. You know, I like the bike. Unfortunately, there's some bad news with that. It is not the ideal investment for you, and this is obviously not even the ideal time. We're trying not to be greedy. We're trying to time the market at the right times so you maximize your returns while also minimizing risk. Peloton is not that vehicle, in my opinion, for myself. Maybe it's not for you also. Okay, guys, I'll have another video up shortly. Until next time, have a good one.